It's happening, folks, and it feels like we are back in late February. Everything is diving, cases are increasing, other countries are locking down, and at the time of shooting this video, the S&P 500 is down 3.17%. The Dow Jones down 3.23%. And my lord, just look at the NASDAQ. Down 3.55%. And we thought it was holding up stronger as the market crashed earlier this week, but look at it now. What a disaster. And the market had been trying to recover, but it just hasn't been able to do it. And every time it tried, it just got railroaded over. But at the same time, congratulations to traders. UVXY, which is our fear index, is up something like 40% on the week. Since we spoke about it in the beginning of our top stock video earlier this week, and since we briefed on it repetitively. You look at SQQQ, massive runs. You look at SPXS, massive runs. Obviously, folks, sell-offs in the market are nothing short of gold mines for traders. And yes, before you say it, it is true. We traders are greedy folk that love profiting off the fear of the masses. Why else would we want to make money when the market is down? It's just pure greed. It's great, but it's pure greed. But anyways, in all seriousness, this is just a horrific day for the market. We got every sectors that did well in the recovery this year, and sectors that did poorly, all getting beat down in a bright red sea. People are looking at Google and saying, throw out this trash. People are looking at Johnson & Johnson, Amazon, United Health Group, MasterCard, looking at those as worthless junk. I'd rather invest in rat excrement. And unfortunately, I can already see what's going to happen. We're going to have the sell-off. All of these new traders are going to look at this and say, oh my god, we have to buy the dip. What happens in any and every long-term downtrend is you'll get these days where the stock market just gets obliterated. And then all of a sudden you have one day where the market's up and all of these new traders are like, oh my god, I called the dip, and they start throwing capital in on those days. Then the market keeps going down and they get railroaded because they don't have a plan. And then instead of learning how risk management works, they'll go on to write Huffington Post articles about how trading is rigged, the stock market is just a big Ponzi scheme, and how you should do yoga instead of trading because, hey, let's face it, hot yoga has much less risk. But honestly, look, this video isn't about fear-mongering. It's about presenting the facts and the evidence, my outlook on it, and much like we did at the end of February, it's about presenting the unprecedented opportunities that come with a potential crash. But anyways, before we get into this video, the only thing that I ask in return is that you hit that ravishing like button and also subscribe if you want to keep up to date with the biggest events in the stock market right now. Okay, so a few days ago in my The Market is About to Crash video, I highlighted 3 reasons for which I thought that the market is due to correct. The first of which was cases, and the focus today right now is 100% cases. You look at cases in the United States, they're continuing their uptrend, and it's hard to see this slowing down anytime soon. Reality right now is investors are looking at this case increase and getting slapped in the face with deja vu. Our domestic cases are going up, but Europe is getting hammered. You're once again sitting back in the US and watching as spectators on how other countries are handling their virus outbreaks. And what are we seeing, folks? Major EU countries imposing lockdowns. And France just announced that they're going to be imposing a 4-week national lockdown. And this isn't a joke of a lockdown either. This is one of those orders where people are only allowed to buy essential goods, seek medical attention, or exercise. And this is France, folks. And look at their numbers. You look at October 25th. Google reported that France had 52,000 new cases in a day. That same day, the US had reported 59,000 cases. Only problem is that the US's population is almost 5 times bigger, and France still almost tied the US in cases. You look at Germany, in many ways the economic powerhouse of Europe, and a country hailed to have handled the crisis well in the early days, while cases are on a clear and rapid uptick. They are imposing new restrictions as well, though not yet as extreme as France. You have the UK, Ireland, Spain, and Italy showing signs of popping. The media is already saying again that the US trajectory looks much like Europe. When have we heard this before, folks? Oh, I remember back in the early days, every outlet was putting on headlines that we were on a trajectory to be like Italy, and then when it came to New York, we were on a trajectory to be like New York. And once again, government officials on both sides of the aisle are saying that we aren't going to have to lock down again, and if we do, it'll only be a partial lockdown. LOL. Remember back in February, folks, when they said, we won't lock down, we won't lock down. Don't worry, we won't lock down. You know, they only stopped saying that once they actually decided to lock us down. And look, I'm not saying anything about that decision or saying that I have a better solution. I'm just talking about this from the perspective of an investor. And by the way, when I say lockdown, I mean complete shutdown like we saw in March and April. I don't mean just the restrictions. Most places have some restrictions in some way or the other, but I mean complete lockdown. But what I am saying is that from the point of a spectator and a stock market investor, you should look at other countries as indicators of what may happen here in the United States instead of just taking politicians at their words. Because remember, when the United States faced out lockdowns back in May, 70% of voters said they would support the same measures again if we got a second wave. But we are literally watching tons of other countries either implement lockdowns or consider implementing them. And we know that if cases get bad enough here, it's almost inevitable that we have some form of lockdown again. And here's the thing, even if we don't get lockdowns in the US on any widespread level, well, investors are still going to be scared. Consumers are still going to be scared. And, well, local governments are still going to be scared. And so in many ways, we don't even need a lockdown to kill our economy and the stock market. We just need enough people to be scared enough to stop spending, to start making fearful economic decisions, to start hoarding cash. This is all we need in order to kill our economy. And let's be real, we are in a much worse situation now to have a lockdown than we were in March. And I'm not talking in terms of the actual beer bug itself. I think we're in a better situation with the beer bug. Let's just grant for a second that the US has become better at handling this damn virus. I think most of us agree that after fighting this all year, the US now has more therapeutics, better procedures, better equipment, and at least a somewhat better understanding of what this beer bug is and what we are facing. It certainly doesn't have a better way to control the spread, but let's just put that aside for a second because we're talking about pure treatment. And again, I'm not a doctor nor someone who is qualified whatsoever to make that statement, but from an investor's perspective, I think most of us can agree that the statement I just made is true to some extent. We're better off at treating each case now than we were back when it started. We know more about it now. Okay, so now that we've granted that, you may therefore make the connection that because we are better at treating this, a second lockdown wouldn't be as bad. You'd be wrong because the actual evidence points to a second lockdown being much, much worse for our economy this time around. And that's because this time around, our economy just can't take the hit. If you look at the beginning of the crisis, we entered it in a pretty good position. GDP was still growing quarter over quarter, the stock market was at all-time highs, unemployment was low for nearly every group, interest rates were low, but I mean they still had some room to drop, and so on and so forth. You could say that we had a lot of tools at this point to deal with a crisis like this. But then the crisis came, and to mitigate the economic blow, the Fed used aggressive force by dropping interest rates to record levels. It infused tons of capital into the economy, increasing its balance sheet at an unprecedented pace. The federal government passed aggressive emergency stimulus measures that basically threw money at companies trying to keep them afloat. And let's be real, private investors threw money at the market, hoping to get in on some of this recovery aid. But now here we are, in late October going into November, and we are very much in the same situation we were in the beginning of the crisis. Except now we have many more cases, and we are looking at impending lockdowns and new restrictions. But instead of going into this with a strong economy, we are going into it with a scab of an economy. The economy right now is sort of like a scab that is healing. Like, sure, it's not exactly an open wound, it's healed a decent amount. And if you could just allow it the time and appropriate conditions to heal, it would heal eventually. But if you scrape it again and rip off the newly formed skin layer on top, all of a sudden you have a more chronic issue and you risk scarring. Maybe you'll need plastic surgery to fix the scar. And let's just say that the virus case increase is starting to scratch at that newly healed scab. It hasn't ripped it off yet, as it has in many European countries, but it's scratching the surface, folks. But this time, if the scab opens up again, businesses are weaker. They've already had to deal with so much and barely hung on. And the Fed has already deployed many of its tools and says that it doesn't want to get any more aggressive. Powell is basically saying that we've been so aggressive that he doesn't want to escalate it anymore, and any more help needs to come from Congress in the form of stimulus. And where is the stimulus? LOL. doesn't look like that is coming anytime soon. Unlike before, we don't have any evidence that we're going to have those emergency provisions that move quickly and aggressively and strongly in the beginning of the crisis. And at the same time, the economy needs that stimulus more than ever. Perhaps Congress can come together if things get bad enough, but right now it just doesn't look like it. The next point is that we are right in the beginning of a major holiday season. A lot of retailers that struggled throughout this year were hoping on a huge rebound in spending as the economy got back together. But as cases rise, people start looking at the numbers and saying, wait a second, maybe I'm at risk of losing my job again. Maybe I'm less financially secure and I'm not sure what my future looks like. So maybe I'll hold off on buying that gift from TJ Maxx for Susan. Or maybe I'll delay buying Allison that Hermes bag or Jeffrey that Gucci tie. Maybe I can't afford to shop at that luxury brand Target. Maybe I'm not going to buy a new TV for my family this year until I see how the crisis goes. You get the point. People cut back on discretionary spending and non-essential purchases if they think their future income is at risk. But going back to the charts, I think that for most of the market's recovery, investors were thinking, hey, you know what? This is a thing that is going to be over in early 2021, mid-2021 at worst. In the earliest days back here, most people thought it'd be over by fall 2020. But now we are in fall 2020, and let's be real. It doesn't look like this is ending in any significant way within the next 6 months to a year. So you have all this money here that is starting to come to the conclusion that, hey, wait a second, this isn't ending as fast as we thought it would, and we also don't have as big of a handle on controlling this thing as we thought we did. And at the same time, we are trading not far from all-time highs. So they think, why not sell out now and take our profits while we're up, and then at the very worst, just buy back in when we can get a better deal later on. And I think that that is very well represented in the current market's performance. Okay, so how do you make money off this, Charlie? Well, number one, memorize your short fear funds. This morning we explained in our morning briefing that we were going to have a deep red open because of futures trading at that time, and that red opens tend to cool off the rest of the day. But that if it doesn't cool off like it didn't today, that is a huge evidence of a stronger, broader downtrend. And likewise, UVXY is our fear fund. It goes up when fear is rising. SPXS is our shorting the S&P 500 fund. It goes up when the market goes down. SQQQ shorts the NASDAQ. This is great for when tech especially is very weak. And for people who are in our Zip Trader U program, I give daily morning briefings on what I'm playing, what the market condition looks like, and where I think the opportunities are. And also understand that it's not a bear market across the board. Momentum plays are on fire. For example, ISIG was one of our briefings yesterday, huge run up into open. GOED was another one, ran up massively after the briefing. TDOG was another play that we briefed on, and it's been running up on earnings, and it's just been on this complete tear. Doesn't seem to care at all that the market is selling off. But of course, make sure to never hold through earnings because earnings can really be a random gamble. MGen was another one that we briefed on. I briefed on it late, but it didn't really matter. It was up on an acquisition deal and ran up massively later in the day as well. So anybody that tells you that you need to stay out of the market because there's no opportunities is completely lying to you, or they're just ignorant, because there are tons and tons of opportunities. Now, if you want to stay out of the market because you don't think you can act rationally or you don't have your emotions in check, then I agree. You should absolutely stay out of the market. But if your head is on straight, it is time to pillage. It is time to pillage and take advantage of all these opportunities while they're here. Because honestly, eventually we're going to have a slow market again, and it's not going to be as fun. We saw some remnants of a slow market the last couple months, and right now we're back in fun market territory. So be prepared to put the work in and attack these battlefields as we get them. Anyways, folks, what do you think about the current market condition? Let us know in the comment section below. And by the way, if you think our morning briefings would be helpful to you, you can get them by joining us at Zip Trader U, which is linked below, with, of course, a coupon code that will get you $50 off. But let me warn you, Zip Trader U does have a one-time fee. But in return, you will get lifetime access to the program, the chat room, and all of the morning briefings. But the truth is that I don't think that Zip Trader U is worth paying for if you aren't going to complete it as designed. If I was somebody looking to do this program, you better bet that I'd be doing all of the lessons probably multiple times, that I'd be answering all of the quiz questions, that I'd be participating in the private chat every single day, and of course I'd be practicing relentlessly and I'd be keeping up to date with the morning briefings. And you better bet that I'd be taking advantage of that lifetime access for as long as I possibly need it, so that I can get the most bang for my buck. Casually put, I would want to get my money's worth out of Zip Trader U. So, I expect the same from you. Don't join us unless you're willing to get your money's worth out of it. And of course, if you are broker curious, Webull is actually giving 3 free stocks now if you sign up and deposit with their commission-free broker, linked below. So if you are wondering what broker to trade with, they are a great place to start, and 3 stocks is actually pretty impressive because they can be valued up to this amount. But anyways, enough with that. Have a great day, folks, and I'll see you in the next video.